Welcome back to World Affairs in Context, everyone. Thank you so much for joining me. Today we're covering a major story rocking global markets. The US dollar is sliding toward a 3-year low mark. Government bond yields are rising at the same time, and investor fears are mounting over America's surging debt. So this is not a pretty picture, let me tell you. With weak economic data and renewed trade tensions adding fuel to the fire, which I discussed in great detail in one of my videos yesterday, this is a turning point that could reshape the financial landscape for years to come. So with that, let's dive in. On Monday, the US dollar dropped 0.7% against a basket of its trading partners. That move puts the US currency dangerously close to its 3-year low mark. In my recent interview with the New York Times best-selling author and financial expert, Larry McDonald, Larry noted that the US dollar will continue to weaken, and this is a secular, not a temporary process. He said, expect a weaker dollar moving forward.
What global investors are saying is that why should I hold, and this is part of the decay in confidence, why should I hold a 30-year bond if I'm not getting that kind of like traditional protection from recession risk or from the stock market going down? Since 2022, investors around the world have been losing money on stocks and actually losing money on bonds at the same time. And if you look around the world, that's the thing, Lena. That's the thing that typically happens into emerging market countries. So at the end of the day, the bottom line is the point we make in our book. The guys that are smoking in the dynamite shite in Washington have created a dynamic where the U.S. has become like 5 or 10% more like a Brazil. And our markets are starting to act when stocks go down, bonds go down, the dollar goes down all in the same day or week. That is shocking to the core. Your global allocators of big bond buyers are just shocked, and they're coming up with a portfolio right now. They want to own more Aussie dollars. They want to own the Korean won. They want to own some Bitcoin. They want to own some platinum, palladium, gold, silver. They're owning an entire basket of assets that are not really dollar exposed because they have to get down dollar exposure.
It was a fascinating discussion, a really, really great one. I learned so much from it. Larry shared his perspective on investment options, and it was a really, truly valuable conversation. I will link our interview in the video description below for you to watch next. You will learn so much from it. But this week, the dollar's decline followed a surprisingly poor manufacturing report. For the month of May, the Purchasing Managers Index came in at 48.5, which is well below that neutral 50 mark that separates expansion from contraction. It's already happening. Additionally, it was also a decline from the previous month, which signals ongoing weakness in U.S. industry. This downturn in manufacturing performance is now widely being attributed to the continued fallout from trade tensions. Markets actually responded quite quickly, and at the same time, concerns over U.S. fiscal stability grew even louder. The yield on 30-year U.S. Treasury bonds rose 0.03 percentage points, hitting 4.96%, nearly 5%. Rising yields indicate falling bond prices. That's how it works. It works in opposite directions. And this is a clear sign that investors are demanding higher returns due to increasing risk perceptions. Higher risk, higher return. So the higher the yields, the more the U.S. government has to pay to service its debt. Treasury Secretary Scott Bessent attempted to calm nerves by assuring investors that the United States is, quote, never going to fail, never going to default. Those were his words. But the reassurance came just days after JP Morgan Chase CEO Jamie Dimon warned that the U.S. bond market could crack under the weight of the country's rising debt load. With all of that being said, the shift in sentiment has big implications for the US dollar. Wall Street banks are increasingly predicting more weakness. For example, Morgan Stanley now forecasts that the US dollar will fall to levels not seen since the 2019 health crisis, expecting the US dollar index to fall by 9% down to 91 by the middle of next year. JP Morgan Chase remains bearish too, and Goldman has raised alarms over potential new taxes that are embedded in recent legislation. According to their strategists, these tax changes, particularly higher taxes on passive income like interest and dividends earned by foreign investors, that could further erode confidence in U.S. assets. Goldman also stated that their model suggests the dollar is currently 15% overvalued, which indicates that there may be more room to fall. Again, this is terrible news. I do want to emphasize that the drop in the US dollar is not happening in isolation. It weakened against all of its group of 10 peers on June the 2nd, which is a sign that the pressure is quite widespread. The Bloomberg Dollar Spot Index fell as much as 0.6% on the day, reaching its lowest level since 2023. Matthew Hornback, Morgan Stanley's global head of macro strategy, said on Bloomberg TV that international investors are, quote, taking a second look at the exposures to the United States, particularly in terms of currency risk. Again, Larry McDonald went into great detail about this particular issue in our interview, and he provided really good details that help you grasp the broader outlook and the context of what is happening right now in the market. He added that increased hedging by the investors will keep applying downward pressure on the dollar over the next 12 months. So we are going to see more weakness. Let's look at the currencies benefiting from this move. I will focus on top 3 today. The euro jumped to a more than 5-week high, reaching $1.14 as the trading began on June the 2nd. Morgan Stanley actually forecast that the euro will further rise to around $1.25 by next year. The British pound, currently around $1.35, may actually strengthen to $1.45, and the Japanese yen surged 1% on Monday, the same day, trading at $142.54 per dollar. In short, currencies with stable domestic policy and fewer trade entanglements, let's just say, are becoming more attractive. So as you can see, flip-flopping on your trade policy and on your economic policy in general does very little for stability domestically and internationally. So are you surprised at all? I don't think you need to be, because if you follow my videos, I've dedicated hours and hours of the past month focusing on economic weaknesses and the threat to the US dollar. Okay, so there are also implications for US interest rates and bond yields. Morgan Stanley now expects the 10-year Treasury yield to finish this year at 4% and then decline next year as the Federal Reserve may deliver a rate cut. Barclays currency strategist pointed out that headwinds for the dollar could come from further bond market weakness, an escalation in trade wars, or even softer economic data, or all of the above. Looking ahead, investors are closely watching labor market data that is due this week, especially the May employment report, and that is going to be a key indicator of where the Federal Reserve heads next. If you're interested, make sure that you're staying tuned. So stay tuned, and I will upload a video once that report is out. At the same time, trade tensions remain a looming threat, and that is something to keep in mind. As I mentioned in one of my videos yesterday, both the United States and China accused each other of violating a trade deal that was signed a month earlier in Switzerland, and if negotiations do break down even further, that could of course place even more pressure on US assets and the dollar. And that brings us full circle. The dollar's role as the world's primary reserve currency is being reassessed, it is being challenged, not just because of current economic weakness, but due to longer-term concerns around policy stability, US debt, and global diversification. The coming months will be pivotal for the dollar and for global investors. We'll keep tracking the data and trying to decode what it all means for you. Ring the bell to enable video notifications so that you don't miss my future videos. Stay updated. Thank you very much for watching. Please remember to show your support, like, subscribe, and share. It really means a lot. I put a lot of work into these videos. And for more content, make sure that you check out my Substack, worldaffairsandcontext.com. I would love to see you there. Enjoy the rest of your day, and I will see you back here tomorrow. Bye for now.